Ghana's Cedi tends to look steady for a moment, then wobbles again. And that touches everything. Fuel, transport, school fees, food. What's behind that wobbling? This explainer will break down the latest data to show you the Cedi's biggest drivers. Spoiler alert, there are no quick fixes, but understanding the root causes can help us prepare better. Hey everybody, and welcome back. Let's start with where we stand today. The Cedi looks like this. The interbank USD GHS mid-rate is about 11.95, inflation for August cooled to 11.5% year on year, and the policy rate sits at 25% after a big July cut. Now, before we dig into the 5 main reasons why lasting stability is hard in Ghana, let me briefly explain what stability even means. Well, in the FX market, stability doesn't mean the exchange rate never changes. That's unrealistic. It means a few things. 1, predictability. Businesses and people want to know what to expect so they can plan. 2, reduced volatility. Fewer wild swings that can upend budgets and economic plans. 3, lower inflation. Stability reduces the chance of a sudden surge in prices. And 4, sustainable reserves. It's not enough to boost reserves with a one-off loan or borrowing. You need policies that make it easier to earn and keep dollars over the long run. So why does the Cedi struggle to be stable? Here are 5 reasons why. 1, raw materials. First, let's talk about Ghana's structure. The country relies heavily on a few primary commodities for foreign exchange: cocoa, gold, and oil. But here's the catch. The prices of these commodities are mostly set on world markets that we don't control. Cocoa prices depend on global demand, weather patterns in West Africa, and even disease outbreaks. Gold prices depend on the global jewelry market, central bank sales, and investor appetite for safe assets. Oil prices depend on global supply and demand, OPEC decisions, and geopolitical tensions in oil-producing regions. So because we rely on these few commodities for most of our foreign exchange earnings, when their prices swing, it affects the amount of dollars we earn, affecting the exchange rate. Reason number 2, ownership. Second, consider who owns many of the big businesses. In recent years, Ghana has attracted foreign investment in sectors like mining and oil. While this is great for growth, these companies often repatriate some of their profits back to where they came from. In other words, they send dollars out of the country. Additionally, international investors can sell their holdings in Ghana at any time, especially when global risks seem high. In essence, the prospect of regular profit outflows and the possibility of investors exiting quickly adds a constant pressure on the Cedi. Reason number 3, over-reliance on imports. Third, think about what we buy from outside. Despite efforts to boost local production, Ghana still imports many goods and services. These range from everyday items like food and medicine to machinery and industrial inputs. The key point here is that we import a lot. This constant demand for imports puts upward pressure on the Cedi because it means we always need to buy dollars. Reason number 4, the US interest rate magnet. Fourth, consider the influence of US interest rates. When the US Federal Reserve raises interest rates, the American dollar becomes more attractive to investors worldwide. They want to put their money in dollar-denominated assets to earn those higher returns. This increased demand for the dollar pushes up its value relative to other currencies, including the Ghanaian Cedi. To make matters a bit more technical, higher US rates tend to attract capital from all over the world, increasing demand for the dollar and putting upward pressure on its value. And finally, reason number 5, expectations. Fifth, there's the role of expectations and speculation. If businesses and individuals believe that the CDI will depreciate in the future, they might rush to buy dollars now. This rush can accelerate the depreciation itself, creating a self-fulfilling prophecy. Think of it like this. If everyone believes the Cedi will weaken and they all rush to buy dollars, the Cedi will indeed weaken, making everyone's initial fears come true. To wrap this up, each of these reasons alone can impact the exchange rate, but when they combine forces, the effect can be more significant. Picture a boat on the sea. Each reason is like a wave pushing on the boat. By itself, a wave can be manageable. But if multiple waves hit the boat at once, it can easily tip over. That's what's happening to the Cedi. Okay, now let's dive into the latest data to see how these factors play out in practice. In the first half of 2025, Ghana earned $14.13 billion from exports of goods, but spent $22.42 billion on imports, resulting in a deficit of $8.29 billion. This points to a persistent structural problem. Let's break it down further. In the first half of 2025, Ghana exported about 4.4 million metric tons of cocoa worth approximately $2.59 billion. Gold exports reached nearly 335,000 ounces, valued at $1.58 billion. Oil exports amounted to 21.2 million barrels, worth about $5.64 billion. That's the income side. Now, looking at the expenses, food and agricultural product imports alone rose to roughly $3.25 billion in 2024. This underscores how much of what we eat still arrives via the port, underlining a consistent dollar outflow. In essence, while Ghana has made progress in diversifying its economy, the country remains heavily reliant on a small number of commodities for its foreign exchange needs. Understanding these dynamics is crucial for planning both at the personal and national level. On a personal level, it's wise to budget in a way that anticipates potential currency fluctuations. For businesses, it means making decisions with the knowledge that the exchange rate might shift unexpectedly. At the national level, it calls for policies that focus on reducing dependence on volatile commodities, growing competitive industries, and diversifying sources of foreign investment. For example, policies that support the processing of raw materials locally instead of exporting them can bring in more foreign exchange. Think about this. If Ghana can process cocoa beans into chocolate and export the finished product instead of exporting raw beans, it can earn more dollars. Similarly, policies that encourage the growth of industries that export high-value products can help. This could be anything from textiles to software development to tourism. All of these efforts aim to reduce the country's vulnerability to external shocks and build a more resilient economy. It's also important for Ghanaians to keep a close eye on global events. International developments such as changes in U.S. interest rates, commodity prices, or global economic growth can significantly affect the CDIs. Staying informed and adapting quickly when needed can help individuals and businesses navigate these challenges. Lastly, fostering a stable macroeconomic environment is paramount. Realistic budgets, transparent debt management, and sound monetary policy can go a long way in building trust and attracting stable forms of foreign investment. In conclusion, achieving stability for the Cedi is a complex challenge influenced by various internal and external factors. While there is no quick fix, a combination of strategic policy making, diversification of the economy, and careful monitoring of global events can pave the way for a more stable and resilient currency. Thank you for watching. I'm your host. Subscribe for more updates. And until next time, stay curious.